From the morning reading, the SPX makes another new all-time closing high. Week 2 earnings season has several winners and several losers, notably with Netflix coming down on an earnings miss. 7 of 9 sectors moved higher and one was unchanged on Monday. XLK, XLB, and XLY were the strongest sectors, while XLP was the weakest sector. All futures fell 37 cents to close at 45.91. Breadth strengthened compared to the prior session as advancers led 1904 to 1091 on the New York Stock Exchange and led 1390 to 1190 on the NASDAQ. All 4 broad market ETFs made new closing highs on Monday. Qs, Spiders, IWM, and Diamonds, with the Qs the strongest. Stocks have finally caught up with Wall Street. The average strategist had the year-end target of 2152 for the S&P 500, and the index is now above that target. This is the first time in more than 400 days that the S&P has been, in quotes, overvalued in this sense. The other time it has gone a long time below strategist target price, it led to good longer-term gains. In the shorter-term, volatility expectations have collapsed. The VIX is below 12.5, its lowest level in nearly a year, despite being in the midst of earnings season. When the VIX has declined to such a low level in July, it usually hasn't gone much further over the next few months. More than 40% of the indicators are now showing excess optimism. Stocks have tended to struggle when this measure exceeds 40%, with an annualized return of negative 30.6% since the 2009 bottom. That's reflected in other models as well, with smart money only 23% confident in a rally, but dumb money 77% confident. The spread of minus 54% is the worst since 2012. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:25 a.m. Mountain Time, and I'm recording this in preparation for the market day, July the 19th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And action overnight across all 4 U.S. broad-based indices is slightly negative, with the S&P futures down about 0.25%, Russell futures down just below scratch, NASDAQ about 0.25% down, and Dow futures are right at scratch. Crude oil's up about a little over 0.5%. Euro's down about 0.33%. Bonds are up about 0.5%, and gold is up about 0.25%. In overseas action, it's mixed. China down 0.25%. Hong Kong down over 0.5%. But Japan up about 1.33%. Germany down a little over 1%. United Kingdom down about 0.25%. In terms of macroeconomic reports for today in the United States of significance, you have building permits and housing starts. And looking forward to tomorrow, you have the weekly crude oil inventories. And that's about it. So a few reports, not terribly excessive. But there are some that are capable of being market movers, especially in their particular market areas. In terms of current volatility conditions, as you heard one of the morning authors mention, volatility is really very low. In fact, probably amongst the lowest levels of a year. Short-term VIX at 10.99. Skew just continues to remain slightly above the warning threshold of 125. IV percentiles, all single digits. On the S&P a 6, the Russell a 7, the NASDAQ a 2, the Dow a 1. Only one market put in a standard deviation move yesterday, and that was the NASDAQ. And you see, really, it's almost, in quotes, normal in that we've had about 4 standard deviation moves in the last 2 trading weeks, though in the last couple sessions, just this one market has put in a standard deviation move. So volatility seems to be starting to damp down after what we saw was a pretty significant cluster of multiple standard deviation moves at some points going both ways. Seem to be starting to calm down a little bit. In terms of the charts, let's go ahead and bounce over there. It is starting to look like we might be getting a little bit of slowing of momentum. You see these candles are getting smaller. They're starting to congest. And, you know, perhaps put in a short-term top. We'll see if this pulls back into a bull flag. Has not yet done that. None of these retracements have really led to anything other than just a 1 day of weakness. So we'll see if this starts to form into something more of a retracement. We've gone a long way with really no significant retracement. You had this kind of 1 day pattern here with a 1 day intraday low, but that was then reversed and then off to another leg. So that was technically a bull flag right there, but you know, certainly nothing of significant retracement. And then you've had just this kind of congestion, confluence activity here. So, you know, we've come from about 1980, we'll call it, up to 21, almost 70, about 190 points with, you know, nary hardly a day of pullback. So that we would set up something, especially after breaking to new all-time highs, of a pullback and perhaps even a pullback to the prior resistance, now support, that certainly could be tested. We've been talking about that for several days. The same thing is setting up potentially here in the Dow. We're watching this because this could be an excellent point of entry to add 2 positions or to add some puts in some of the positions we'd like to own perhaps, or bring in some option income. At this point, with the current market conditions, any kind of retracement is expected to be nothing more than a bull flag continuation pattern and not a serious risk for a correction until proven otherwise. And we have to kind of take that approach. In terms of the NASDAQ and the Russell, no changes from really the chart observations from yesterday, in that we've had the important horizontal and diagonal breakouts, but still have room to go to get back to the all-time highs in these more growth-oriented indices. So important that from a bullish perspective, we start to see these areas firm up. In terms of the stubs, let's take a quick look at those. Here's your utilities. Utilities has had something of a consolidation pattern, but certainly no significant retracement. Staples, of course, I think was the weakest one yesterday, if I remember correctly. Well, that certainly isn't much of a retracement there. So there's that one. Here's your bonds. Bonds clearly have retraced. So when you think about Staples, telecom, utilities, bonds, you've seen some evidence of rotation, particularly out of bonds and out of gold, but not so much out of telecom and utilities. So just kind of keep that in mind. In terms of volatility, let's take a look at that. And you see the current futures chart, and we're down here about as low as it's been. In fact, the 52-week low is really literally a year ago on the VIX futures chart. We'll take a look at the VIX. 10.88 was our intraday low almost a year ago, and certainly we're in that ballpark, but not quite that low, probably about 1.5 points away. We are looking to take a additional advantage of this in the trade room. We've been putting on some long-term hedges and some intermediate-term hedges. I'll probably be looking to add to that today if I get a chance. So it's definitely, the volatility is starting to get into that area where we are quite interested in setting up for the increase in volatility, which will come. It's really only a matter of how long will it take. In terms of, let's see what else here. We got the indices. Okay, let's take a look at crude oil. Crude oil continues to settle into what we believe at this point to be something of a wedge pattern, but it's in the middle of the cloud, very neutral position, making a series of lower lows and lower highs, but in the bigger context, it's within this wedge or potential wedge pattern from a prior bullish trend. We would expect that this will probably break to the long side at some point. We probably need some more highs put into this wedge and see this wedge kind of come down towards its apex just a bit more to be able to be sure that this is not a channel as opposed to a wedge. But right now, that's the definition that we're going with. So watch crude oil to probably continue to chop around in a sideways pattern in the very short-term future on the daily candle basis. Okay, I think that's probably enough with the charts for today. Let's go ahead and go to the daily report. Not a lot of changes on the daily report. And remember, when you're in these kind of bullish trends, you don't get a lot of warnings. Things get into normal status, and they kind of will stay there for extended periods of time. That's what you want if you're a bullish trend trader. And right now, we certainly seem to be in that kind of mode. Intermediate term phase opinion is phase 2, trend reversal, the break of diagonal and horizontal resistance. Very bullish there. Our 3 market timing signals, no changes from yesterday. The first from IBD, confirmed uptrend, bullish. The second one, the GMI index, a perfect 6 out of 6, and on the GMI 2, an 8 out of 8, buy signal in place since July the 1st. And the third one, the stock charts decision point scoreboard, that mechanical signal is also almost universally bullish. We're waiting for these long-term mixed signals that we're getting across the indices to turn long to give us the perfect stack and put all of these mechanical signals into a bullish mode. So we're just about there. Portfolio sizing opinions, both these mechanical models coming in at 100%. Whether you're talking about a portfolio investor or a volatility, more active trader model, they're both at 100%. Intermediate term market posture, extremely strong bull signal with a supporting bullish sentiment line. All these are up over 90, really almost all up over 95. There's really very little room for them to get much higher. But do remember that as long as this is up over 80, it will still retain its severely strong bull description. So it will have to start to not just fall a day or two, but fall probably pretty significantly before we lose that status, because you're expected to have little teeny pullbacks and bull flags and so forth within a bullish trend. So anything over an 80 is considered still in that severely strong area. Strength of trend, very high. Hedge warning status, still a level 0 plus. Normal with some cautionary aspects, though those are actually pretty few at this point, primarily coming from those long-term signals with the decision point scoreboard is the reason this is still a 0 plus and not just a flat-out 0. If that happens, it would be the first time we've been at level 0 under hedge warning status in a very, very long time. In terms of option income strategies, VIX is acceptable to initiate new positions, cover calls, and put selling. Certainly in line to initiate new positions, and increasingly bullish with a 1-to-2 ratio of in the money and out of the money strikes and a 1-to-2 ratio of low beta versus high beta. consider legging into those covered calls with more aggressive setups through out-of-the-money put selling, especially if you're going to do something before you get a pullback. This situation where we've had these record highs one after another, they can continue to run and kind of, in quotes, leave you behind. So you have to be kind of cognizant of that. But many of these breakouts do pull back. In fact, it's about 70% of the time that these breakouts pull back and test the former resistance, now support. So you don't want to get too many new positions out in front. You better to kind of scale into positions as you gain confidence in the bullish move. If it does pull back, it would certainly be an opportunity to do some put selling. And so you should be developing a watch list of things that you would like to add. Perhaps you'd like to build some new positions and maybe even stock by legging in through put selling. Just make sure you use defined risk positions and position size in the scale you're willing to own. In terms of current warnings, really the same two weak warnings are still in place. You got the volatility ratio warning, which is in the extreme zone, waiting for a new firing signal. Has not yet happened. Skew just barely above the warning threshold. So that's it, the volatility. There are no warnings in the trend base and no warnings in the key intermarket risk aversion indicators sections. Sentiment does bring a couple warnings, but remember, sentiment can remain extreme for prolonged periods of time. Really what this does is when we get these higher levels, it tells us to watch for reversal patterns, and certainly that would be the case in these three highlighted ETFs, mining, silver, and retail, all with excessive sentiment levels. Watch for potential reversal patterns if you're in any of those markets. Fear and greed index is certainly extreme. This 91, less than 5% of your trading sessions have such excessive sentiment levels using this indicator. So that should certainly be a heads up to you to keep your eyes open for these reversal patterns. In terms of sector specific, you can see it's a sea of green. All time frames, all sectors are all bullish in their intermediate term market postures. In terms of percent change for yesterday, let's take a look here at how this breaks down. Kind of a high beta area, high beta, high beta, high betas. All the high betas were kind of risk on kind of areas were the top performers yesterday. Utilities, though, was still positive. Telecom was a scratch. Only consumer staples was negative by any measure at all, and really it was just below scratch. So the defensive sectors were pretty much a wash, while the higher beta risk on were the areas that were getting some new capital yesterday. At the same time, there wasn't enough action and enough dynamic in terms of the percent gains and so forth to get too excited about that action. But that's also typical of bullish move, where you just kind of crawl up. And we often describe it as the stairwell. You just kind of take slow steps, often little baby steps up, and then of course pullbacks can be sharper and faster. It's like taking the escalator or elevator down. And you look at the 5-day, we should pay some attention to this. In the 1 month, you see for the week that the 5-day trading week, that the higher beta areas have outperformed the stubs in general, but also when you go to the 1 month out, there's really not a lot of separation between the risk on and the risk off areas of performance. Also, the other thing I would start to note is that we're starting to see far more consistency across the different time frames: 1 day, 5 day, 1 month, 3 month, year to date, even 1 year to date. 1 year time frames, or rolling 12 months. we're starting to see more consistency across these different sectors and actually achieving something. So that's one of our complaints that we've had for this last year and a half prior to the recent breakout, is that we were moving back and forth but never actually achieving anything. That buy and hold crowd especially had nothing to show for themselves. Well, that's starting to turn in its story, where these are actually, up and positive for the 1 year rolling time frame. So we'll see if this continues to build and build some confidence in this bull leg. It's starting to show evidence of it, but so often in the last 18 months, just when we thought things were safe and it was, as it were, safe to go back in the water, that shark shows back up and we go right back into the old trading range. So we're a bit hesitant still, with good reason, and yet at the same time, we have to respect what all these different indicators that we've put together that look at the market in so many different ways are telling us, and that is telling us that there is not a lot of warnings out there in these different areas to tell us that there's justification for being overly cautious. So we need to reflect that in our trading and our portfolios, and yet at the same time kind of have one eye a little askance because of the multiple failures that breakouts have had in the past. This one's a legitimate breakout. Will this one be different? I think that's probably enough for today. Let's go ahead and wrap this thing up. Let's go to the disclaimers. Disclaimers, as always, you hit the pause button if you need more time to review the disclaimers, and then also note the hyperlink at the bottom for the full set of disclosures. We'll see you back here for tomorrow's market preview session from Falcon Global. As always, manage that risk and everything else will take care of itself very well, and you'll be here to trade another day. Good trading.